Good evening and welcome to my weekend recap and trade plan for the coming week. First, I'm going to go over the trades I've taken this week. Tuesday looked like a couple of breakdown trades were about to set up, so I took these 31 May 282 puts here at 169. Reason being, I zoomed over too far. We're breaking this lower wick here from the end of Friday. Had a nice base, lower high off of the VWAP. Looked like a nice breakdown setup. So took these at 169, trailed me out almost immediately at 162 because that trade was failing. As it came back up to VWAP, I did take a resistance trade here at these 282 puts, the same puts before, at 143. Reduced some here at 163. The rest trailed me out at 151 as I got my stop too close. Those went very nicely in the money had I been able to hold overnight. Later on in the day, we did have the official breakdown. I was a little bit late getting into it, but still capitalized on the move. Caught these 282 puts here for 29 May at 101, reduced at 120. Towards the end of the day, reduced again at 195, and held the last lot here overnight and took those off here at 355. Wednesday, anytime there is a SPY gap down, I have a very specific strategy that has over 80% win rate. So I took these 279 calls here at 64, reduced some here at 84, reduced again at 84 on the way back down, and trailed me out at 68. Now, I should have gone a little bit closer to at the money, maybe 278.5 calls would have paid out very nicely. Didn't quite gain as much as I had hoped, but still a winning trade nonetheless. Second setup here looked like we had a nice volume break higher above VWAP here, so I took a lotto trade here. Now anytime I have lotto in my trade plan or in the name in my journal, I need to just scrap those trades because a lotto is simply that. There's no edge. It's basically like throwing money away, and that's pretty much what I did here. So in at 20, out at 13, it is what it is. Later in the day, per my last video plan, I was looking at 277 calls for the end of June, or excuse me, the middle of June, but they were just extremely expensive. The volatility was just outrageous in all options this day. So I took the 278 calls here at 467, reduced some here at 493. The rest trailed me out at 473. Of course, in hindsight, if you follow along with the markets, you see this gapped up nicely the next day and would have paid extremely well. Just had my stop too tight and didn't have any faith in the market continuing higher. So that's that. On to Friday, I also tried this same exact strategy, which in hindsight, of course, it worked, but I had no faith in the market following through. I need to follow my strategy and stick to these statistics where 8 out of 10 of these trades are going to work. This did not void the low. There was no reason to close. I manually forced myself out. This was the 276 calls here at 96, and I closed right here at 89. Had I waited 5 more minutes, these things went, I believe, 50-60% profitable and would have been a very nice way to end of the week. But it is what it is. On to my trade plan for this week. I will be looking at short setups and scalps from the short side. So with that being said, it's tough to really throw those levels and those setups on the chart here. I do still have my same note here. If price action is able to reclaim the 200 SMA right here, that's what I'm looking at, taking another swing in these 277 calls. Now, it will take some time for that to set up, because as of right now, it looks like the overall market is down approximately 20 points, 25 points, and continuing to drop probably on the tariff news with Mexico, Europe looking to put tariffs on other countries, and I think I saw some headline where some countries are going to put tariffs on Australia, of all places. So right now, the market is not liking the tariff news. Now, with a new month closing, I want to go over each sector of the SPY. This here is the communications ETF. Very weak month. Maybe it's only retesting here this 46.20, 46.25 area. But in the grand scheme of things, even though it is a young, ETF, it has now put in what I'm going to consider a lower high and starting a downtrend. May come back down here to test below 40. On to XLY. This is the consumer discretionary ETF. Did put in a new high here recently, only to sell off, not unlike what it did mid to late 2018 on significant volume. Anytime there is significant volume off of a base like this, if the chart was flipped upside down, I would consider it accumulation. Being at all-time highs and the setup that it's currently in, looks to me like it's possible distribution. Now, I have a theory that these ETFs are designed to go up, and they will continue to do so until some sort of outside force impacts them negatively. Now, that being in the current environment, tariffs and headline risk and the tweet monster and all that good stuff. Looks like distribution to me, probably going to come back down most of these sectors, in my opinion, to test these late 2018 lows. That at that point, there are a lot of individual names that will be, I don't want to say oversold, but they will be undervalued. So for now, looks like distribution, smells like distribution. Just I'm going to sit on my hands and wait before putting any significant capital to use in the names I want to invest in. On to XLP. This is a consumer staples ETF. This is put in a big range here for the last 3.5, almost, going on 4 years. Big range here between 58 and 48. Above and below there is where it needs to go in order to create a new trend. But again, this is something that looks like distribution to me. You can see these big red bars here from highs. There is somebody selling. Of course, there has to be somebody buying as well, which leads into my theory about these ETFs are designed to go up. So in order to reduce the size of shares that push this move down and this move down, there has to be some sort of a big buyer absorbing that. There's simply not enough retail in the world to dump that kind of stuff on. So even though it is distribution, it does need to base. I don't think everything's going to fall apart completely unless we're going into another depression, which I guess is not really impossible, just unlikely at this point. Onto XLE, an energy ETF. This is setting up in an H cell setup. You have one large setup here, and this one over the last almost a full year setting up here. So anything below 55.60 looks like it's coming down to test 50, and going to put in a new relative low in relation to late 2018's sell-off. So right now XLE is not looking too healthy at all. Onto XLF, the financials ETF. Even though it does look like there is a bull flag setting up or a wedge that could be considered bullish, there are still several large banks that are undervalued as far as price to book that should be, or at least could be, investable in my opinion. XLF is not looking too healthy. Fortunately, it did not take out April's lows, and the gap down that we're going to have tomorrow may be a buying opportunity, may be a capitulation kind of move, but that will have to remain to be seen. I do think a lot of these ETFs are going to come back down and test this late 2018 low, so we got to look at XLF around 22. XLV is next up here. That is the healthcare ETF. Again, another name that is selling off from recent highs on elevated volume down here. Looks like distribution. Again, there's got to be big money picking it up somewhere. It just depends on where it's going to base, and right now it's anybody's guess, to be honest. If this trend line breaks, most likely it's going to come back down to around 80 flat. And one thing I do want to point out here is the inside month here for XLV. Healthcare names are probably going to be in play this month, or at least for the first week, maybe even off the open on Monday, to see if they're going to continue this slide down, because significant volume on an inside bar. There's a battle going on, just like on a daily basis. If there's a bar that's set up like this on elevated volume, whichever way it breaks is probably going to lead to a significant move higher or lower. So you're looking at above 91 for bulls and below 86.70 for bears, in my opinion. Since it's already closer to lows, the futures are gapped down pretty heavily right now. Breaking that low is going to be very likely. Now, if there's a gap down, which there's most likely going to be, and then it reclaims that low, that may lead to an outside bullish bar here for the month and climb back up over 91, which those individual names that are in healthcare that may be in play will catch a significant boost. The one name that I have seen catching a lot of activity lately is Pfizer, as far as call activity and big block trades. Next up is XLI. This is the industrials ETF. Another ETF that looks like distribution at highs, probably going to come back down, test late 2018 lows, maybe not all the way back down there, but it has just put in a new lower high, so maybe it actually does break down. And I don't know, I don't really trade too many industrials. It just looks like a very weak sector to me, and if materials, industrials, transports are all weak. It tells me, or at least it implies to me, that maybe the consumer is not as healthy as we've been being led to believe, and there's not demand for goods. Goods aren't being made, they're not being shipped, they're not being produced. So some companies are going to suffer. On to XLK. This is the technology ETF, has recently broke out of, at least recently in the last year and a half, broke out of all-time highs, putting in a possible handle here for a huge cup and handle here over the last almost 20 years. Big pattern like that, I don't know if it really carries too much weight. I mean, just have to wait and see if that actually does play out. But anyways, put in a big bearish engulfing month here in into May. And again, something else is going to be gapping down. If it gaps down and starts to reclaim or climb back up and reclaim that low, maybe it's a buying opportunity. Maybe it's worth putting some money to work in some of those technology individual names. But for now, again, I'm going to keep saying this, it's time to really be patient and wait for these ideal setups to present themselves. So everything is looking extremely weak. On to XLB. This is the materials ETF. As I said, if materials, industrials, and transports are weak, it seems like the consumer is weak, which is ultimately going to impact the bottom line of individual names. So it's probably going to roll a snowball over on itself and impact the overall market, because sales, revenues, profits are all going to go down if there's not selling as many goods as before. So for now, again, something that looks like distribution and going to come back down, and this one most likely is going to be the first or one of the first sectors to test the late 2018 lows, simply because you now have two lower highs after a series of lower lows. So if it does come down to 47 flat, we'll call it, and breaks below, that is definitely in a downtrend, and should be put on the back burner, at least stayed away from for the time being. XLRE is up next. This is the real estate ETF, one of the very few sectors that actually shows relative strength. Recent breakout as far as, or as early as, what was this, March. Looks to be holding above, even though this is a potential, not really a hanging man, but could be a potential reversal, bearish reversal setup here from the month of April. May held up fairly nicely. Seems like that's maybe a quote-unquote safe place to park some capital, capture some dividends, and some REITs, home builders, and that kind of stuff. But real estate, even though a lot of individual names have been hit pretty hard, this ETF looks pretty strong. So those strong individual names in the real estate sector may be worth taking a look at. XLU, this is the utilities ETF, is another sector that still shows relative strength, trading at all-time highs. But before putting any significant money here, I would take a look and see what's happened the last time we make all-time highs. First time here, sold off to support. Next time, all-time high, sold off to support. All-time high, sold off to support. Probably going to do the same thing. It may climb a little bit higher before doing so, but I would expect about a 10 to 15% pullback before any significant money is put back to use in the XLU. Now on to transports. This is IYT. Potential new lower high here. Does not look like one of these steady downtrends or a pullback like here in 2015, where it was just a steady, slow drop down. This is actual selling, just strong selling, in my opinion. You know, this huge drop here, October, December, obviously we all remember that, was unable to get back up to recent all-time highs, broke down through the 200 SMA very strongly last week, and just started to run away from it. So if you're a follower of Dow theory, so much like I am, you'll know that transports can be looked at as a leading indicator for the overall market for reasons I've already stated. If products and goods are not being transported or bought or sold, they're not being made, all that stuff's going to come into play in the overall market. So even though I say that these ETFs are designed to go up through rebalancing, consistent application of money into these names, and big money has to sell to big money, so it can't really fall too hard. I do still believe that, but there are outside factors that are now impacting the market, or at least have been impacting the market for a couple of months, and may put that theory of mine to the test. So If big money is not putting their money to use, then they're just letting the robots buy and sell on the way down. They're still going to make their money. There's no way around that. But anyways, as I've said, all these ETFs, in my opinion, are designed to go up until acted upon by an outside force, whether it be economic, political, or both in the current environment. It's just time to be patient and let things really base and set up before putting any significant money to use in your favorite individual names. So for now, I'm going to trade the SPY. From the short side, I will scalp if I do have more gap downs like we're going to have on the open today, or excuse me, on Monday. I will look for that opening counter trend trade, and then I will flip and watch for short opportunities to capture some more downward momentum. One significant level, I'm not sure if I mentioned at the beginning, is this 272.35, 272.40, all the way down to 271-ish area, which is where I'll be looking at, maybe taking profits, maybe there's going to be support there. But from my last video, I believe a couple weeks ago, there is a big bear flag, big head and shoulders pattern that sets up that takes price action down to a measurement of about 265 for SPY. So that's worth keeping in mind. For right now, cautiously bearish still. We'll take trades from the long and short side, and we'll see what happens that sets up this week. If you have any questions or comments, please feel free to leave them down below. Come join me over there at the Trade Crew chat room if you want to follow along with some of these live trades. Enjoy the rest of your weekend, and good luck this week.